Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast episode 68, podcast episode 58 for the week ending February 5th, 2021. We're coming to you live from Tampa, Florida. Special week. We had to take our two daughters down to Florida for a swim meet because Connecticut is still closed, and the only meets happening were down in Florida where business is open. And while we were down here, we heard a lot that there were some tickets still available. I thought it would be kind of silly sitting in the hotel room 5 minutes away from the stadium watching the Super Bowl. So we're going to head over there. Let's hope the girls enjoy it, and it should be a lot of fun. So as a 43-year-old man, I'm rooting for Tom Brady. We like to always believe we've got one last shot for athletic greatness at this age. I'm a weekend warrior with ice hockey, which pales in comparison, but we'll be out there rooting. And Mahomes has many decades to win many Super Bowls, so we're all rooting for Tom here. I know half of you just tuned out on that news, but anyway, we're hoping for a nice time, and it was nice to see that tickets were available for sale. So we killed two birds with one stone on this trip, and want to get right down to it this week. We're going to quickly run through the media. We usually go into detail on the media. We're going to do that later in the call this week. First, I'd like to thank Liz Clayman and Jackie D'Ambrosi Scales for having me on the 2nd, which was Tuesday. We'll go into that in detail in our weekly article. And want to thank Jill Wagner and Allie Thompson and Taylor Gary for having me on Cheddar the day after on Wednesday morning. And we're going to go into some real detail on that call. She asked me a great question at the end because we were talking a lot about GameStop and other things in the market, and she said, what advice would you give to brand new investors, especially these ones that got involved with GameStop through this Reddit message board, etc. And I really, it took me by surprise, and I just thought back to the most important thing that I ever did starting in this business was I read a book that was suggested by Warren Buffett when I was at the annual meeting in Omaha. And, here's the quote. At age 19, I read a book, The Intelligent Investor, and what I'm doing today at age 76, he was older at the point that I read it, is running things through the same thought process I learned from the book I read at age 19, and that is The Intelligent Investor by Ben Graham. And it talks about the short-term voting machine versus the long-term weighing machine. Why I think this is so important is I'm seeing more and more highly credible people, and they've been right, saying that the whole investment game has changed forever, and that stocks are no longer based on fundamentals, and that it's based on momentum or what the future is going to be, or the story, or a combination thereof. And I think what we're going to find, as we have for decades and decades and over a century of data, is that it's not different this time. And those who are out there saying that the game has changed and you've got to just play momentum, and who cares about the value, the earnings, it's only about total addressable market and growth expectations, etc. There is some to that. There's always going to be some to that in new industries. That's the case. But that's all short-term mindset. What's going to happen in the next year? What's going to happen in the next 2 years? And what people do is they take one or two examples that worked exceptionally well. Effectively, you're looking at Tesla, which was able to pull it off, and Amazon, and both absolutely changed the world. But you had, in those two cases, really what you were betting on was the jockey to change the world. And many of these companies that are getting extremely rich valuations on the basis of some narrative about TAM or being in the right place at the right time with EV SPACs, etc. I think what you're going to find is that the short-term voting machine will eventually give way to the long-term weighing machine, and you'll have a few winners, but by and large, the vast majority are not going to meet the long-term weighing of fundamentals and intrinsic value. And that doesn't mean it has to trade at a discount to book value. I think when people think about value investing, they think in a narrow range, buying $1 for 50 cents, and that no longer is the case. But if you can buy an earning stream at a reasonable price, PEG ratio, discount to the expectation of how quickly they can grow earnings, that's another form of value, and there's a tremendous opportunity there. So I think by reading that book and suggesting that book, it really gives you a leg up to understand the basics. And then if you want to take it a step further, once you read that book, either it's going to click for you and your life will never be the same, or it's not, and then that's perfectly fine. Go on and build a business, go on and do something else. But that changed my life forever, that book. And the second thing you want to do is go to the Berkshire Hathaway website and read every single annual letter that Warren Buffett has ever written. And it doesn't mean that you have to be explicitly a deep value investor, because there's so many different ways to make money. And that's the other thing that I think people miss in this business, is they think that there's only one way, you can only do it this way. And the fact of the matter is, there are a lot of people making a lot of money doing it different ways. For me, I have a longer term mindset, and this works exceptionally well. But for other people, they like quicker things and seeing immediate results and buying things that are on momentum, and that can work as well. So, but that's a great way to start, because what we saw happen with GameStop was a perfect example of, in the short term, the market is a voting machine based on momentum and emotions, and in the long term, it's a weighing machine where it reverts back to the intrinsic value. In the case of GameStop, part of the original value thesis, as purported by Michael Burry of Scion, and then this other guy, Roaring Kitty, who went on YouTube and did a pretty good job. If you look at his first video from July, he did decent analysis. A lot of it was repetition of the case that Burry had laid out. But then when it got into this whole diamond hands and don't sell no matter what, that's the type of emotionalism that eventually backfires, and we see it now plummeted from 483 down to 50 or 60 wherever it closed today. So that would be my suggestion. We're going to go into some more substance of what I covered with Jill, but thanks again to Jill, Allie, and Taylor from Cheddar. I want to thank Herbert Lash and Tom Arnold for including me in their Reuters article earlier this week. And this was as the CME, the Reddit traders, went to silver on Monday, and the CME solved the problem the right way. What they did was they just immediately raised margin requirements and took the froth right out. And what also happened was the GameStop trade started to unwind, and what was effectively happening was everyone rushing for the same narrow exit, trying to get off margin. And what were known as quote-unquote diamond hands, meaning hold strong, don't sell, proved to be many cubic zirconias as they were getting out in fits and starts. So, and that completely unwound. So next is, want to thank Saleha Riaz for reaching out to me for Yahoo Finance UK. That was also related to the silver why was silver collapsing after it had such a run, and that was the CME doing the right thing. And that was one thing I covered in a CGTN segment that will be coming out next week, and we'll find out with the investigations of Robinhood, etc. Why did they restrict trading when they could have simply raised margin requirements, or have a situation where brand new traders, maybe you have to be in a probation period for 6 months before you start to get access to margin? Why not just increase margin requirements versus just shutting down and restricting trade, which I think, it's interesting because their calculations were correct. They really did the right thing with the analysis, the initial analysis of GameStop, maybe a little too optimistic on the digital transformation or too quickly, but the short squeeze was right. It was irresponsible for the hedge funds to be 140% short. They figured it out, and candidly, had Robinhood not shut off buying, there's no question in my mind that stock could have gone to 750, it could have gone to 1,000. There's no telling, because there was momentum behind it, people were getting squeezed, and what effectively happened when Robinhood put that restriction on is they wound up doing the opposite. They stole from the poor to give to the rich. That decision caused the stock to drop from 483 to 200, where a lot of hedge funds covered, and they were able to live another day. Had they not done that, I think 750, I think 1,000, that would have blown a lot of people up and caused a lot of systemic deleveraging and further selling of winners in order to fund the losers. So it'll be interesting to see how these investigations unwind. But the retail guy did beat, Main Street did beat Wall Street, had the rules not changed, but often they always do. They wind up favoring. We saw the articles over the week about the Piggly Wiggly short squeeze in the 20s. You can Google that on Barron's. There was a good example, and it goes to the point that when the big players on Wall Street are losing, they change the rules, and that's exactly what happened. Whether it was due to the capital shortage that surprised Robinhood, is unclear. It will come out, but the fact that they didn't just take up margin requirements versus banning it altogether was a bit surprising, and I think certainly disappointing for the people who were at that point on the right side of the trade. That said, there's no excuse for staying at the trough too long, and we'll talk about that as well moving forward. And we covered that last week. It was time to take some chips off the table. Last week it was at 483 when we put out that article in the 400s. Take some chips off the table, and I hope a lot of people did and cashed in, because there were a lot less chips to be had by the end of this week. And then also want to thank Devik Jain and Meta Singh on the 3rd. And, there was a period of volatility and the market was taking a breather, so thanks for including me in your article. And lastly was the jobs report today. Herb Lash gave me a call this morning after the report. And I said, it's very hard to get pessimistic. There were some material downward revisions in November and in December jobs reports, some 70 and 80,000 respectively. But that's backward looking, and it's very hard to get pessimistic. Even with the miss this morning, non-seasonally adjusted, we lost 3,000. It was negative 3,000 jobs, but then you look at early this morning, the Senate approved a budget resolution that would enable them to move ahead with the $1.9 trillion stimulus, with or without the Republicans. So that's an avalanche of liquidity, almost 10% of GDP. Then you had the vaccinations consistently hitting above 1 million on the 7-day average, plus you've got the cases well below the 7-day average, which is 131,000. It's hit 98,000 yesterday, so significantly below the 7-day average. And you have over an 80% beat rate on earnings, and estimates continue to come up every single week. So despite the softness in the jobs report this morning, it's more backward looking. And then since the announcement that the states are going to get $350 billion of bailout money, they've been reopening. So big parts of GDP, big parts of California are reopening now that they're getting the bailout money. And there was also a attempted recall of the governor in California, so that was probably a catalyst to make some changes. And in New York, you're seeing further openings, so that will be a good thing all around, and that's why the market could largely look through a little short-term softness that we saw from those regional shutdowns this morning. Moving right along, the places where we saw the gains and losses in jobs, this is from CNBC, Professional business services gained 100,000. Leisure and hospitality lost 61,000. Healthcare and social assistance lost 40,000. That was related to a lot to nursing homes, etc. I think a lot of people cleared out of nursing homes in recent months, and as the vaccinations come, hopefully they'll be coming back. Those jobs will come back, and seeing pockets of strength and pockets of weakness. And you had a lot of government ads as well that helped the numbers. These are some numbers from Bank of America through Zero Hedge just put out this afternoon. It just gives you a visual of how the hospitalizations, the deaths, the cases are, it looks like they're falling off a cliff. And that's a very, very positive thing as the vaccinations are just continuing to trend up in a material way. And, I looked at some of these numbers before talking this morning to Herb. And if you look at the number of cases has been 26 million in the U.S. And now 28 million people have received at least one dose of the vaccination. 7 million have gotten 2 doses. So when you add those together, you're knocking on the door of 60 million people. A little less than 20% of the population is now either vaccinated or has had coronavirus and may have antibodies. So, you continue to change that one side of the equation. I think we're going to see cases collapsing here. And, as more and more people get the vaccination, more and more people want it because, there's less concern about it and worries. If my neighbor got it, I'm going to get it. They're out and able to do whatever they want. I want to get back to normal. So these numbers are going to go up really quick. Even if we got up to 30 million cases and 50 million vaccines in the next month, or 60 million, you're starting to get to 50% of the population much quicker than people think. And that's very, very positive. Hard to be terribly negative in that environment. Okay, so this was the budget resolution that was this morning, and so it can't be filibustered. And the next big date for that is February 16th, when they send the budget to get approved. Now you've got the Johnson & Johnson's going to seek emergency authorization for their COVID vaccine. Now this was a little disappointing last week. Obviously, it was 66% effective preventing moderate COVID, but if you get it, it's only one shot, so people like that, and it's 85% effective at preventing severe disease. So it's like, if you get COVID and you don't have major symptoms, is it really so bad to have COVID? I don't know the answer to that, but I do know 85% against severe with one shot is only going to help us get those numbers up to 150, 180, and then whatever we need, 8 times 3, probably 240 million people either having had it or having been vaccinated to get close to some type of herd immunity. So this is certainly good news, not to bet against. Then there was for laughs, the Super Bowl indicator was out, and there's some wrinkle in it that if it predicts that stocks will rise if the game's winner traces its roots to the original NFL before its merger with the AFL in 1966, and it will fall if the winning team can trace its roots back to the AFL. Now, Tampa Bay has no roots in either league, so it's okay if Tom Brady wins because it's an expansion team that joined in 1976. So for a precise interpretation of what a victory by an expansion team would mean, this gentleman named Leonard Kopit went through it, and he said that stocks will rise from Super Bowl Sunday through the end of the year whenever the winning team cannot trace its roots back to the original AFL. That would suggest by interpretation that a Tampa Bay victory would be bullish for the stock market. So there you go. Let's see when we go on Sunday if we can, knock one out for the middle-aged men that want to have one more shot at athletic greatness, and it'll be good for the stock market as well. And Mahomes will win probably 2 handfuls worth of Super Bowl rings over his career, but let's see if this one can go to Tom Brady. All right, moving right along. This was posted on MarketWatch. This is out from Deutsche Bank today. And what they're talking about is, pockets of froth and the retail participation. But they do an overlay of the NASDAQ bubble in 2000 to the S&P radio, phonographs, and musical instruments chart in 1929 peak. And then they're measuring it to the FANG Plus stocks today. And they're saying, it's making the same pattern. I'm not a huge fan of these analogs. But, their commentary was the more things change, the more things stay the same. Today's technology giants are following a similar trajectory to the radio makers of the 1920s, as well as the dot-com era around the turn of the century. So the point is that you can be a firm believer in tech's ability to transform our lives, but still think valuations might be in a bubble, said Jim Reed, strategist at Deutsche Bank. It remains to be seen. I thought it was interesting that Jeff Bezos stepped down at age 57 this week from Amazon. He's going to be executive chairman instead of CEO. Bill Gates did the exact same thing in the year 2000, which was the peak of the tech bubble. But more importantly, I think he did it because the antitrust investigation and morass was upon him. And he made that move right before it got aggressive. And I'm wondering if Bezos is potentially sniffing that environment is getting more aggressive, or if he just wants to go out and shoot rockets with Blue Origin. I mean, he's certainly entitled to do that after 20 some odd years of creating one of the greatest companies in history. But, with Amy Klobuchar, introducing this bill now, this antitrust bill, about technology deals and their inability to do new deals if it's going to hurt other competition. Well, why would you do deals unless you want to gain share? So the winds are blowing. And I don't think that's going to change imminently. Obviously, there are cases all over, state cases, federal cases, etc. So we just have to keep our eye on big tech. Because this is not going away, and now there's a unity where the federal government can move aggressively if they want to on particular matters, and this may be one in the crosshairs, and maybe Jeff Bezos is sniffing that out just as Bill Gates did in 2000. And if that's the case, this Deutsche Bank note, although it seems a little bit hyperbolic, there could be something to pay attention to as it relates to that. I think the number one thing to watch is with the largest degrossing last week by hedge funds since 2009. It's often the case that when you have that kind of massive deleveraging, it doesn't just clear out in one day. It could be the case. I mean, you did have in August 2007. You had the risk parity guys take a monster hit, and it cleared out pretty quickly, but it was kind of the earthquake before you had 2008. So it's something to keep in mind, but the point that I'm making here is as much as there's to be excited and optimistic about in the market, despite a 75% move off the lows, and maybe a little bit push higher here, I do think you're going to see some redemptions in those funds that got hurt, which would have gotten significantly damaged had it not been for Robinhood shutting down the trade effectively. So expect redemptions, and if you are seeing redemptions in those people that were short a stock that had 140% short interest, which you should, then you're going to see selling of the winners, which would be the FANG Plus, in order to fund those redemptions at the end of the quarter, or in some cases, if they don't have quarterly liquidity, it would be the end of the year as they wind down. So it's just something to keep in the back of your mind. There are a number of headwinds pointing to it, but at the same time, you've got record quarters, so you have to balance it. let to run free, they could keep running. I just don't know that the environment is going to be full free market moving forward. I think there's going to be a clampdown because governments around the world want a piece of the action in the form of taxes, and it will start as antitrust and then be settled as more taxes for these companies, which will impair their margins, earnings ability, forward outlook, etc. And other groups will see favored and outperform. But predicting something like a 1920s or tech wreck, I think is a bit hyperbolic at this point, unless government really gets aggressive on this front. Now, this week was a build-on of last week. Last week was the 50 cent in the club, the stock market, about the Reddit boards and the Robinhooders. This week was called The Good, the Bad, and the Ugly, kind of wrapping up the story. This was from a 1966 Italian spaghetti western that starred Clint Eastwood, put him on the map. And the famous aspect of this movie was what was known as a Mexican standoff, where all three characters are seen as anti-heroes, killing for their own personal gain. And it does parallel the scene we saw play out with GameStop this past week. The Reddit rebellion and the Robinhooders were characterized as the good. The retail traders were the good players. The hedge fund shorts were labeled the bad, and the Robinhood platform was coined the ugly after restricting traders from purchasing shares of GameStop and continuing the short squeeze. And like all good Mexican standoffs, there's no strategy that exists that allows any party to achieve victory or walk away unscathed. The diamond-handed Redditors stayed at the punch bowl too long, leaving the latecomers holding the bag, and that was disappointing to see. There were all these things that, this gentleman who put out the original deep value thesis for GameStop, the video where he was talking about, discount to assets and the console upgrade, etc., and that he was going to be investigated, and they always sacrifice the virgin in these type of situations, which is disappointing to see. But what was a little abusive, one, I think it was obviously unfair that these folks were prohibited from purchasing the stocks when they got the trade right. But I think what was a little bit unhealthy was this concept of diamond hands, like encouraging people to hold tight and don't sell a stock that everyone knew. I mean, the most optimistic fundamental valuation price target on the sell side was about $30 a share if everything went right with their digital transformation, and all the most optimistic things that they were projecting about having people come in and play the games in the store, etc., was $30 a share. So when you have a stock at 100 and 200 and 300 and people saying diamond hands, don't sell, and new players coming on with, greedy and seeing these people made all this money and buying up at $300, that doesn't help anything. So so there was good and bad, I think, in all three groups, and none of them got away unscathed. There were hedge funds that will probably wind down. I think Robinhood, although they had huge app downloads last week, I think when all is said and done, a number of people got off after those trades were being shut down. It will delay their IPO. They had to raise a lot of capital. They're going to be under scrutiny. Ultimately, I think it's going to be a good business, but they're going to probably shift to educating people a little bit more, lowering their people's ability to borrow on margin in early days when they're inexperienced, increasing education. And, the other thing is this concept I keep hearing about protecting people from themselves. Look, everyone's got to pay their tuition. I mean, we all learn how to do it right by doing it wrong, whether you're a carpenter, whether you're a pool contractor, whether you're an investor, whether you're a trader, whether you're a business person. Protecting people from themselves, that the implication is that they're, baby children. I do think there's room for guardrails. Certainly, maybe you could have a probationary period with no margin for the first 3 to 6 months, maybe limited option trading, notional, maybe the notional exposure couldn't be more than 2x the amount of equity capital, something to that effect, or you have to wait a couple months to do options till you take a modular course or something like that. But people have to learn by making mistakes, and I think this was an example of it. And I think there are going to be millions of new people. There are 8 million some odd people on this board. Maybe it's 10 million now. I haven't looked in 6 hours, but it's going to add a lot of new people, and probably you'll see tens of thousands who will be amongst really great investors in the next 5 years, in the next 10 years, in the next 15 years, that would have never been exposed to the markets had it not been for this. That's good for capital markets, it's good for capital formation, it's good for business formation. So there will be a lot of good that comes out of this, and that's that. But for now, they all got bloodied up, and there's no two ways about it. Now, in last week's note on January 28th, on that was put out before the opening, the stock traded up to 483. I had 2 quotes. The retail traders had a huge short-term win and mopped the floor with dealers and short sellers, but as the old saying goes, bulls make money, bears make money, pigs get slaughtered. And the second quote was, to the Reddit folks, quote, in the club, those were lyrics from the 50 Cent song, you crushed some big names in the game, make sure you walk away with some chips and live to play another day. You identified the vulnerability that sophisticated players missed, and you deserve to harvest the spoils. Now take some chips off the table while you can, and quote, go sip Bacardi like it's your birthday. That's another line from the 50 Cent song. So I hope many people who read this did that, and to those of you who did, you're probably well set up for retirement. If you're in your 20s and you compound that at 8, 9, 10% over the next 20 years, you'll probably retire in your early to mid 40s. And for those who stayed a little too long, even though fundamentally you knew the intrinsic value was no greater than $30, $40 a share, maybe $50 on a, all the stars aligning 3 years out, we have a picture here of a bunch of pigs at the trough, and there's nothing more than you could say other than you learn from experience. Okay, so in the segment with Liz, we referenced the diamond hands becoming cubic zirconias, and we acknowledged that last week Apple had record earnings, everything was perfect, and the stock was down, and that was because it was being sold out as a source of funds. And that's the thing you want to keep your eye on in coming weeks. Does Apple make new highs here, or does it stay under pressure moving forward? And that'll give you an indication as to whether we're going to have, some consolidation here that's long overdue, or if this is just going to push higher. I mean, if you keep putting a couple $1 trillion in we just put in almost $1 trillion, 3-4 weeks ago with the $900 billion package. Now we're doing another $2 trillion. Very hard to get bearish with that amount of liquidity and stimulus, and particularly with people getting back to normalcy with the vaccines and the cases rolling over. So keep an eye on Apple. That is my tell. If it makes new highs, then all bets are off. If it struggles to do so, then maybe we do go sideways before resuming the uptrend in the back half of next year, and we'll see how that plays out. The CBO was out this week, Congressional Budget Office, nonpartisan. U.S. economy will hit new highs in economic growth by mid-year. Unemployment rate will plummet to 5.3%. It already came down to 6.3 this morning. And inflation will remain subdued. And that is in the absence of new stimulus. Now we're getting this $1.9 trillion on top of it. I think the concept of inflation remaining at 1.5% is very unrealistic. And so, our suggestion to Liz was to ignore all of this noise and find opportunity where there's still value. We love, obviously, as if you've been with me for the last 6 months, we love banks, we love energy, but they've had a monster run in the last 4 weeks. So we're holding what we have, but where do you put new money to work? And we've been talking about aerospace and defense subsector on a second half commercial aviation recovery. We've been continually adding to that. We think over the next 12 to 18 months, that's going to be an outperforming subsector. And while the defense budget is currently flat, we could potentially get some upward revision in that, to couple with all the space business, the satellite business, and most importantly, the commercial aviation, as we heard from Greg Hayes over at Raytheon Technologies when he was reporting earnings last week. So that's very important. Now, as far as the segment with Jill Wagner on Cheddar, in addition to covering all of that and the book recommendation, which I hope everyone finds helpful, there were a number of questions they wanted to cover, but these segments are usually 5 or 6 minutes. We went 7 or 8 minutes, and we still didn't get to these. So I want to cover it with you. And the producer had asked me, where are we with earnings? What do you like what you've seen so far? Earnings are coming in much better than expected on both the top and the bottom lines. If you recall, December 31st, expectations were for negative 9.7% for Q4. It's now closer to negative 2%, and it's going to finish the quarter positive year on year. So in the middle of a pandemic, you're going to have positive earnings year on year. You've got a beat rate over 80% on earnings on the top line, over mid-70s on the bottom line. And financial sector is reporting the largest positive aggregate difference between actual earnings and what the estimates were. This is only going to improve as they release reserves in coming quarters. We've been talking about this since July of last year, and it's come to pass in this earnings season. It's only going to accelerate. The 210 spread and the 230 spread is now the widest it's been in 3 or 4 years. That's going to really juice net interest margin and net interest income, as well as the housing demand for millennials, which on average are age 30, starting housing formation, having babies, and moving out to the suburbs. So I like, obviously everyone knows my top position there is Wells Fargo, and we like that for the next 12 to 24 months. And we think that's got a lot of legs over time and a lot of catalysts with bringing down the efficiency ratio is much higher than peers. They've already started to work on that. They're going to take $10 billion of costs out, and eventually they'll get that asset cap relieved of the $1.9 trillion cap. There's no longer any management that was involved in those sales practices 4 or 5 years ago. They've cleaned up that part of the business, and it's just a matter of time until that is released, and that will be another catalyst as well. So we like to see that with financials. Revenues have grown year on year 1.7% in the middle of a pandemic. That's positive. They're going to grow high single digits for 2021 and 2022. So that's good to see. And the most important point is that the estimates continue to be revised upward each week. At the time of writing this, it was at 172 and 198, up from 168 and 196. It's gone up again this week, which we'll cover at the end of the podcast, so that's really exciting. As far as sectors, energy, industrials, consumer discretionary, materials, and financials are going to grow EPS greater than 20% in 2021, while tech and communication services are going to grow slower at 16.3% and 12.3% respectively, which is lower than the S&P 500, and yet it's trading at a 50% higher multiple. Now, she also asked a good question: what concerns me, and what are the next catalysts for stocks once we get through earnings? In the short term, I'm really watching the US dollar. I've talked about that in recent weeks as it's been showing strength, and hedge funds are record short the US dollar. And no, I'm not worried about the Redditors squeezing the hedge funds in the US dollar, but I am worried about the fact that commercial hedgers have been buying, and the commercials are usually right at these extremes. This would be a short-term headwinds for earnings and stocks if it persists. I think it's a counter-trend rally that may last weeks, not months, but it's something to certainly keep my eye on. Another concern was inflation is likely to come sooner than anticipated, forcing the Fed to act more quickly than expected. It will come from wage inflation. Employers are now competing for labor as pent-up demand returns, and private wages will have to meet or exceed extended unemployment benefit pay. Remember, it's going from $300 to $400 a week, and it's extending from March to September now. And there's no penalty if you refuse a job. If someone offers you a job and you say, I'm worried about COVID, you don't have to take the job. and you still get your benefits. So if you annualize that, state can be as high as 400 plus the 400, that's 800 a week run rate, $40,000 a year. Employers are going to have to pay people just to compete and incentivize people to go into the private workforce. Why would people want to do work for $40,000 a year if they could sit home and get $40,000 a year? Some people just like the pride of it and something to do and feeling good about themselves, which is a very positive thing. But usually they're going to have to pay more than $40,000, which is a lot of money for a lot of businesses. So we will see wage inflation and commodity prices. I've been talking about this for 6 months. That once the OPEC announced the plan in June, the cut plan that will extend through April of 2022, and now with the new administration policies on no drilling on federal land, it's going to affect 30 to 40% of shale drilling, and we're seeing it already at the pump. Prices are starting to go up, and that's going to continue. So we're going to see inflation. And the other thing I'm worried about is concerned. She asked me. The bad news is taxes are going up for corporations and wealthy individuals. The good news is it takes on average 15 months to pass a comprehensive tax bill. So the question becomes, when does the stock market start to discount the reduction in earnings that's going to come from the corporate tax rate? And will the $2 trillion of stimulus offset? In other words, by adding all this stimulus, will we gain an extra $20 of S&P earnings before we lose $20 from the tax increase? And the market is currently betting that the impact of the stimulus and the vaccinations will be greater than the $20 of S&P earnings per share that we lose moving forward, and we'll see if that's the case. I do think as that rhetoric becomes louder, which will be right after they pass this stimulus, they're going to be talking taxes. The market's going to start to get a little bit wobbly on that, but ultimately it should be okay as the market begins to acknowledge that it's going to take some time to get through. Next, what I'm also concerned about is Q1 and Q2 tech comps. Obviously, we had good tech numbers for Q4, but a tremendous amount of demand, particularly with consumer electronics, etc., i.e. Apple, was pulled forward because everyone had to buy that during the pandemic to work from home. Very tough comps going into Q1 and Q2 of 2021. We're going to see how that plays out and how the market starts to sniff that out. The other thing that could set us back is if new strains become resistant to the current vaccines, because it takes a couple months to modify them. It can be done pretty easily, according to the CEO of Moderna, but it does set things back. I think that's a very low probability concern, but she asked me for concerns. And lastly, as we mentioned, the aggressive de-risking of hedge funds last week, redemptions will be imminent. There are aftershocks. Are there going to be aftershocks after the initial earthquake? And it usually takes more than a few days to go through the system, so we'll see. So far, no signs of any aftershocks or tremors, but we'll keep our eyes on it. Next, what's the next catalyst for the stock market? The next catalyst is stimulus. It now looks like that's going to happen no matter what. And what does it all suggest in the absence of further catalysts? Historically low institutional cash levels, which is accurate right now. Certain pockets of froth, record call buying by retail investors, SPAC frenzy, highest margin levels since the great financial crisis and the tech bubble. And a lot of good news already priced in. We could see a situation of a continued consolidation of the gains in coming weeks before resuming the uptrend and closing the year out higher. I certainly think we close out higher. I just don't know the glide path in the interim. My spidey sense says even if we push a little higher here, we probably give some of that back and take a breather in coming weeks. But we'll see. We're prepared for all eventualities, and we know where we're looking for value irrespective of what the general indices do. I mean, the general indices is just a barometer. It doesn't really help. Where you make your money is finding those sectors that still represent value, that have the fundamentals behind it, that over the next 12 to 18 months can outperform. And when we think in those terms, there's no change in, when I can find cheap defense and aerospace, I want to be adding. If banks and energy were to pull back anymore. I would consider adding more, but we're pretty aggressively positioned from mid last year and late last year, and took advantage of that to add more. And that's where we see opportunity right now for new money, with the market at basically all-time highs. It's not, the risk reward was much more favorable 6 months ago than it is today, and except in certain sectors, which is what we're trying to convey and hopefully be helpful. As with always, go to the top of hedgefundtips.com, click on terms, and this is not advice, this is just opinion. Talk to your financial advisor, just sharing what we're doing personally and with our clients who are accredited investors and qualified institutions. So that's that. We put out that article a couple weeks ago, TikTok until the stock market ghosts us. Last week we did get a healthy 3.7% pullback. Was that it? It's really too early to tell. If it does follow our post-election 2017 model, which we had talked about for the last few months going into the election, that was our roadmap. Everyone was pessimistic. We said, here's what we think, how we think it's going to play out. Here's the rotation. Those factors did play out, but keep in mind, in all of the year 2017, you didn't have a pullback greater than 3 or 4%. So if it persists in following that model, maybe that was it last week, and maybe there are no aftershocks. I tend to think we're going to get a little bit more in coming weeks, but we'll see. We'll see. And the only reason it generally matters is not predicting the market, is just saying, okay, other than those areas that are still cheap right now, what could get cheap that we would have an opportunity in the event that we did get further consolidation? Just kind of thinking forward, how much cash to keep available, or to load into that which is currently cheap without having to wait for any further consolidation. That's kind of how we think about that. So the other theme that we've been pressing is, in recent weeks' podcasts and videocasts, is the concept of rallies under the surface. This means that even if the market were to consolidate sideways for some period of time and not make major gains, to digest the gains off the 75% gains off the March lows, certain sectors and stocks would have monster moves, or could have monster moves, under the surface, even if the general indices are subdued for some time. And that's really what we've been getting at in what we try to do here with sector rotation and laying the framework for that. What I'm watching is Apple for a clue. If Apple makes new highs, then probably all bets are off in the short term. But if that remains under pressure a bit, it showed a little bit of strength this week, but if it doesn't make new highs, then maybe we do grind sideways for a bit before resuming the uptrend the back half and finishing the year higher. Sector earnings. We did consumer discretionary this week. The top 30 weights earnings were up 87 basis points in the last 60 days. Consumer staples, top 30 weights, were earnings at 2021 estimates were up 1.06% in the last 30 days. S&P 500 came up again. This is what we were talking about. Last week they were 172, up from 168. Now they're 173.43 for 2021, and almost $200, 199.88 for 2022. So this trend of estimates going up every week, although unusual, is happening, and that is very promising. As far as economic data this week, the key ones were today. You saw the unemployment rate drop. That was good, although non-farm payrolls add was less than expectations at 49,000. Average weekly hours went up. That was good. Average hourly earnings were up 5.4%. That beat expectations. That's in line with my expectation for imminent wage inflation, so keep an eye on that. Continuing jobless claims came down. That was strong. Initial jobless claims came down. That was good. So that was all positive. You had another draw in crude oil inventories. Price continues to go up. That's been a positive thing. You saw Exxon was strong as hell this week. That's a good thing. You had a 1 million barrel draw, give or take. Services PMI was good. That's healthy. Total vehicle sales were better than expected at 16.6 million versus 16.1, very positive. And lastly, construction spending was up modestly. So that's effectively it. So we're going to wrap up. Let's everyone enjoy the Super Bowl this weekend. We are grateful to be down here. I'm more interested in my girls' swim meets on Saturday and Sunday, so please wish them luck. Keep them in your thoughts, and then we'll celebrate it with the game on Sunday night and be back up in New York and Connecticut on Monday. So thanks to everyone for listening in this week. We'll be back next week, same time, same place. Make it a great one.